Earlier, I spoke with J.P. Morgan Chase's private client chief economist about the rate cut. He thinks that the government made, well, the right move.
What they certainly want is the economy to recover. And by lowering reserve requirements, it certainly stimulates lending. One of the things you saw was they lowered reserve requirements even more with regard to agricultural banks and small and medium-sized lending opportunities. So they're really trying to stimulate the economy, because I think there's no question that over the last 12 months, the equity market is doing just fine. The economy could use a little bit of a push, and that's what I think the reduction in reserve requirements was geared to generate.
So the reserve rate requirement, as I understand it, is the amount of money the banks have to set aside, sort of like a deposit ratio here in the U.S., we would call that. How low can that go, and what's the next move then?
Oh, I think the reserve requirement ratio could come down even lower. My suspicion is that by lowering it 100 basis points and even more for other institutions that gear towards smaller types of business, small and medium-sized business, they're moving in the right direction. The reserve requirement ratio, you're exactly correct, is how much the banks have to keep on the side without being able to lend that money. We know that in a world where there was changes in capital inflows and capital outflows, the Chinese had to keep that reserve requirement a little higher in order to regulate those capital flows in an optimal fashion. But now the world is changing a little bit. Now they can lower those numbers, and by lowering those numbers, guess what else the Chinese are able to do? One of the things they've been trying to do is to move away from off-balance sheet items and to move away from lending that takes place outside of the traditional banking system. And that's what they want to do. By lowering those reserve requirements, they bring more business into the traditional forms of banking. And you might say, why is that good? Because it allows the central bank and officials to control credit growth a little bit more.
Yeah, okay,
so essentially, by lowering this ratio, they improve the feasibility or the ability for monetary policy to control the economy, but at the same time stimulate the economy.
So that's sort of the positive side of it. Now, I remember a time from my experience that there was a lot of discussion about good loans versus bad loans. You can tell the banks to loan as much money as they want, but don't they still have to find good investments and good loans to good companies? How hard is that right now?
Well, I think that right now it's been determined, and I think there are many people out there that will agree with me, that small and medium-sized enterprises, agricultural banks and things like that, still could, in fact, make good loans for good investment opportunities. Right now, there's some areas that are sort of struggling a little bit, the housing market, for example. The Chinese government, of course, is making it a little bit easier to borrow money in order to stimulate demand in the housing sector. But there's still other areas out there that are not necessarily going to focus on overcapacity. There's no question that there is overcapacity in China in the manufacturing sector. No question about that. But there are other areas that I think can use a little bit more investing.
The Chinese economy is slowing. I should say growth is slowing. It's not as robust as it used to be. Yet the stock markets had this just quite meteoric and amazing ride over the past 12 months. How do you explain that to a regular person when you explain to them, you see the headlines that the economy is slowing, but at the same time they're hitting sort of medium-term highs on the indexes?
I think it's pretty straightforward. If you take a patient that is very, very sick and the doctor has said this patient is so ill, this patient is sick with a serious infection and the fever is very high, and you start administering an IV or antibiotics, the fever starts to come down and you say, why is the fever coming down? This patient was diagnosed with a real serious disease. Well, guess what? The reason that the fever is coming down and the patient is getting better because they're giving antibiotics, they're giving an IV. Right now, every time the economy shows signs of slowing down in China, the equity market rallies, not because it's necessarily disconnected, but because it's expecting that Chinese central bank officials are going to either give you positive fiscal policy, which means to stimulate the economy, or they're going to give you more stimulus on the monetary side. And guess what? So far, the Chinese are not disappointing. They're accelerating fiscal policy or infrastructure expenditures. And guess what? They've lowered interest rates a few times. They lowered reserve requirements by more than twice what the market was expecting. And I think that they haven't finished. I think before that, in the next couple of months, you're going to see Chinese officials, the PBOC, lowering interest rates even further.
Anthony Chan, thank you very much.